Imagine you are sitting at your kitchen table on the 29th of June. 2 days before the new financial year, you have a term deposit. You have some savings sitting in the bank. You have been thinking about putting some extra money into your superannuation before you retire fully. And you think to yourself, there is no rush. I have got until the 1st of July. Plenty of time. And then you find out. The deadline was never the 1st of July. The deadline was midnight on the 30th of June. And by the time you picked up the phone to ask a question, it was already too late. The window had closed, and a decision worth tens of thousands of dollars to your retirement was made for you, by default, simply because nobody told you the real date. This is happening to Australian retirees right now, this week, because almost every article, every news report, every well-meaning friend at the bowls club is getting the actual deadline wrong. I am John from Centrelink Support Hub. And if you have savings, superannuation, or an account-based pension, the next 20 minutes could be the most financially important 20 minutes you spend this year. Stay with me, because today I am going to walk you through exactly what is changing on the 1st of July 2026 for Australian retirees with savings. I am going to tell you exactly who needs to act, and just as importantly, who does not need to worry at all. And in the final 3 minutes, I am going to give you one specific dollar figure, a figure that represents exactly how much could be sitting on the table for retirees who time this correctly, and exactly how much could be lost by those who do not. But first, the single biggest mistake Australian retirees are making right now with this deadline. I am naming it in the next 60 seconds. I am coming back to it 5 times before this video ends. The mistake is this. Retirees are assuming the date that matters is the 1st of July. It is not. For almost every single rule we are about to cover today, the date that actually matters is the 30th of June, the day before, your balance, your decision, your timing, all locked in at midnight on the 30th. Not the 1st. That is the mistake. And it is currently costing retirees real money, simply because of a one-day misunderstanding. This channel exists to close that exact gap. Hit that subscribe button right now. Think of it as your retirement timing insurance. Every single week, we bring you the verified facts. Straight from the ATO, straight from Treasury, straight from the official government legislation. So a single date never costs you a cent. If you are watching this video before the 30th of June, you are already ahead of 90% of retirees who are going to find this out too late. Let us make sure you are one of the ones who acts in time. Now, let us get into the facts. The real, verified, government-confirmed facts for 2026. Here is the big picture. On the 1st of July 2026, several major changes to superannuation and retirement savings rules take effect in Australia at exactly the same time. Some of these changes are genuinely good news, some require careful timing, and one of them, despite what headlines are screaming, does not affect the vast majority of people watching this video. I am going to be completely honest with you about which is which, because this channel does not exist to scare you. It exists to inform you. Change number 1, the transfer balance cap. Let me explain this the simple way. When you retire and you want to start drawing an income from your superannuation, you move your super into what is called a retirement phase account. Money sitting in that retirement phase account earns its investment income completely tax-free. 0% tax. Compare that to money still sitting in the accumulation phase, which is taxed at 15% on its earnings. But there is a limit on how much you are allowed to move into that tax-free retirement zone. That limit is called the transfer balance cap. Right now, in this financial year, that cap sits at $2 million. Stop right here. Look at this number carefully. Write it down. Rewind 10 seconds if you missed it. From the 1st of July 2026, that cap rises from $2 million to $2.1 million, an increase of $100,000. Here is why the date matters so much. The cap that applies to you is not based on when you retire. It is based on the cap that exists on the exact date you start your retirement phase pension. If you start your account-based pension on the 30th of June, You are locked into the $2 million cap for the rest of your life. If you wait just one single day and start it on the 1st of July, you are locked into the higher $2.1 million cap. If that sounds like a $100,000 difference based purely on a calendar date, it is because it is. Now, this only matters if your superannuation balance is approaching or above $2 million. If your balance is well below that, this particular rule does not affect you. And I will tell you exactly who it does affect in a moment. Wait. What I just found in the fine print of the 2026 rules is something almost nobody is explaining correctly. Change number 2, and this is the one causing the most confusion and the most fear online right now. It is called Division 296. You may have seen frightening headlines calling this the $3 million super tax. Let me tell you exactly what it is, and just as importantly, exactly who it does not apply to. Division 296 is a new additional tax that applies only to superannuation balances above $3 million. It takes effect from the 1st of July 2026. For the portion of your balance between $3 million and $10 million, an extra 15% tax applies to your realized earnings, on top of the standard 15% super tax, bringing the total to 30% on that portion. For balances above $10 million, the extra tax rises to 25%, bringing the total to 40% on that portion. Now here is the important correction that almost nobody is making clearly enough. In the original version of this law, the government proposed taxing unrealized gains, meaning you could be taxed on paper growth in your super, even if you had not sold anything or received a single dollar in cash. That version caused enormous concern, especially for self-managed super fund holders with property or business assets. That original version has been changed. Under the final legislation that passed the Senate in March 2026, unrealized gains are excluded. You are only taxed on realized earnings, meaning actual income and actual gains you have received. This is a significant and positive change from the original proposal. If that sounds like the government listened to genuine public pressure and fixed a flawed policy, it is because they did. Friends, tap that like button right now as a vote of solidarity for accurate information over scary headlines. Your like tells the algorithm that honest reporting deserves to be seen, and it costs you nothing. Now let me be completely clear about who this affects. If your total superannuation balance is below $3 million, Division 296 does not apply to you. Full stop. This is not a tax that touches the savings of an ordinary Australian pensioner with $200,000 or even $1 million in super. This is a tax aimed specifically at the small number of Australians with very large superannuation balances. Let me introduce you to someone who learned this the hard way, not because the tax applied to her, but because she nearly made a costly decision based on fear rather than facts. Her name is Patricia. She is 71 years old. She lives in Adelaide. She has a self-managed super fund with her late husband's share portfolio inside it, worth around $400,000. When she saw a headline calling this a $3 million super tax raid, she panicked. She called her financial advisor in a state of genuine distress, convinced the government was about to tax her retirement savings into oblivion. Her advisor had to calmly explain, "Patricia, your balance is $400,000. This law applies to balances above $3 million. You are nowhere near it. You have nothing to worry about." Patricia is not alone. Thousands of ordinary Australian retirees are currently frightened by headlines that do not apply to them. This channel exists to make sure that does not happen to you. Now, why do two retirees with the exact same superannuation balance end up with completely different outcomes after the 1st of July? I am going to answer that question before this video ends. But first, let me tell you about the change that genuinely does require action from a much broader group of retirees, including many of you watching right now. Change number 3, the bring forward rule and contribution caps. This is the part of today's video that has a real, practical deadline attached to it. And it is the part most closely connected to today's title. If you are a retiree with savings outside of superannuation, money sitting in a bank account, a term deposit, an inheritance, or proceeds from selling an investment property, and you are considering putting a large lump sum into your superannuation before you fully retire, the amount you are allowed to contribute depends entirely on your total super balance as measured on the 30th of June, 2026. Stop right here. The 30th of June, not the 1st of July. Write this down. Here is exactly how it works. If your total super balance sits under $1,840,000 on the 30th of June, you may be eligible to use the bring forward rule and contribute up to $390,000 in a single year, using 3 years of your contribution cap at once. If your balance sits between $1,840,000 and $1,970,000, your bring forward capacity reduces to $260,000, using 2 years of cap. This is the real, practical, do this before the deadline moment that applies to a meaningfully broader group of retirees, not just the ultra-wealthy. If you sold an investment property this year, if you received an inheritance, if you have savings sitting outside super earning lower after-tax returns than they could inside the concessional super environment, this is the window where timing genuinely matters. If that sounds like a penalty for not knowing the exact right date to act, it is because it is. Now I want to clear up one more piece of confusion that is spreading widely online. Many retirees believe the compulsory superannuation guarantee rate, the percentage employers must pay into super, is rising again on the 1st of July 2026. It is not. The superannuation guarantee reached its final legislated rate of 12% on the 1st of July 2025. It has been stable at 12% ever since, and no further increase has been legislated or announced. If you see a video or an article claiming the super guarantee rate is going up this July, that information is incorrect. I want you to have the truth, not the headline. Comment your state and the word truth in the comments right now if you have seen confusing or contradictory information about these July changes online. Type your state and the word truth. I read every single comment, and your responses directly shape what I cover in my next video. Now let me tell you about one more genuine change worth knowing. It is called Payday Super, and it begins on the 1st of July 2026. From that date, employers will be legally required to pay their employees' superannuation contributions on the same day they pay wages, rather than the current system, where many employers only pay super quarterly. For retirees who continue some part-time work after reaching pension age, this means your super contributions start earning investment returns sooner, rather than sitting unpaid for up to 3 months at a time. Over many years, this compounding head start can genuinely add up. Now let me answer the question I asked you earlier. Why do two retirees with the exact same superannuation balance end up with completely different outcomes after the 1st of July? The answer is this. One of them knew the real deadline was the 30th of June, not the 1st of July. One of them checked their total super balance before making a contribution decision. One of them understood that Division 296 does not apply below $3 million and did not panic unnecessarily. One of them spoke to a financial advisor or called the ATO before acting. The other one waited, assumed they had more time, and missed the window. That gap between the retiree who knew the real date and the one who did not is exactly what this channel closes every single week. Here are your 5 rules. Write these down or take a photograph of your screen right now. Rule 1. If you are planning to start an account-based retirement pension and your superannuation balance is approaching $2 million, speak to a financial advisor about the timing of your pension start date before the 30th of June. Starting on or after the 1st of July may allow access to the higher $2.1 million transfer balance cap. Rule 2. If your total superannuation balance is below $3 million, you do not need to take any action in relation to Division 296. It does not apply to you. Do not let frightening headlines push you into an unnecessary or costly decision. Rule 3. If you are considering a large lump sum contribution into superannuation from savings outside super, check your total super balance as it stands on the 30th of June 2026, not the 1st of July, as this determines your bring forward contribution capacity for up to 3 years. Rule 4. Call the ATO Superannuation Inquiries line on 131020 to confirm your current total super balance before making any contribution decision. This is a free call and gives you the exact figure the ATO holds on file for you. Rule 5. If you receive a full or part-age pension and hold savings in bank accounts or term deposits, call Centrelink on 132300 and ask for the Financial Information Service to understand how any further deeming rate reviews from the 1st of July could affect your fortnightly payment. Now, I promised you a number, and here it is. For a retiree who times their pension start date correctly around the 1st of July 2026 instead of the 30th of June, the difference in tax-free retirement phase capacity is exactly $100,000. $100,000 of additional savings that can sit earning 0% tax on its investment income, rather than 15%. Over a 20-year retirement, at a modest investment return, that single-date decision can be worth tens of thousands of dollars in compounding tax savings, $100,000. Decided entirely by which side of midnight on the 30th of June your pension paperwork was processed. You worked 40 years through Australian summers for this money. You paid your taxes. You built this retirement savings with decades of discipline. It is your property, not a government gift. And you deserve to know the exact dates and the exact rules that protect it, not the misleading version that scares you into an unnecessary decision. Share this video to your senior WhatsApp groups and Facebook pages right now. One share could help someone in your community avoid the same one-day mistake that almost cost Patricia her peace of mind. Send it to your accountant, your financial advisor, your sibling who is about to retire. They need the real dates, not the panic. I will never ask for your private data. I only ever show you the legal path to your own money. That is my commitment to this community. Always. Now, today, we cleared up the real deadline. We corrected the Division 296 confusion. We gave you the 5 rules and the exact figure at stake. But in my very next report on this channel, I reveal something that affects nearly every single age pension recipient in this country, not just those with large balances. Your base fortnightly payment is under a quiet pressure from a rule buried deep in the 2026 budget, a rule that has already begun reducing payments for thousands of ordinary pensioners who have done absolutely everything right. If you do not watch that video, today's timing knowledge will not be enough to protect your full retirement picture. Go watch it now. It is already on this channel, and I will see you there.